Hi everyone. In this quick video, I'll go over a question with you in Excel that will help you understand the basic structure of an income statement and also how you can use an income statement to calculate net income and addition to retained earnings. So suppose there is a company called Gia Incorporated. It has sales of $497,000, costs, depreciation expense, interest expense, and then a tax rate of 21%. The question is, what is the firm's net income? And also, assuming that the company paid out $30,000 in dividends, what is the addition to retained earnings? Now, what I've done here is that I've used all this information to construct a very basic income statement for Gia Incorporated. An income statement, as the name suggests, shows how and how much net income a company generated during the entire year. Net income means income net of expenses. And so the basic structure of the income statement is that you start with sources of income. For most companies, that's sales or revenue that they generate in sales. Now, some companies may generate a portion of their income through other non-revenue related sources. Example, some interest income that is being generated on, say, cash that is lying around in some checking accounts. From those, then you subtract costs. Now, there are two types of costs. The very first set of costs that we subtract are called operating costs. And as the name suggests, these are costs that result due to operations. So an example of an operating cost could be purchases that you made of any raw materials that you needed to produce your product. An example of an operating cost could also be wages or salaries or money that you're paying for utilities. These are all part of costs that you have to incur to do your day-to-day operations. Depreciation is also an example of an operating cost, although it is a special kind of an operating cost because no cash actually leaves your business because of depreciation. Think of depreciation as the value that you're losing on your assets because you're doing your day-to-day operations. Now, once you subtract these operating costs from sales, you get something called Ebit, which is short for earnings before interest and taxes. Sometimes this is also referred to as a firm's operating income. And you can probably see why, because it is the income that is being generated from a firm's operations net of its operating costs. From this number, you subtract interest expense. Now, interest expense, it is a special kind of expense. We refer to this as a financing expense. And the reason why we treat it differently is because this is not driven directly due to operations. This is something that is driven by how the manager of the company chose to fund the operations, which in this case means that the manager chose to have some sort of debt. This was a choice. It's not driven by operations. Put differently, you can have two otherwise identical businesses which might have similar sales and similar costs because raw material costs the same, and similar depreciation because they require similar kind of depreciation. But if one manager chose to fund all those operations using his or her hard-earned money, whereas another one chose a lot of debt or took a bank loan, then one business will have a high interest expense and the other won't, even though their earnings before interest and taxes, or EBIT, will be very similar because that will be driven from operations. And so that is why we typically keep financing expenses like interest expense separate from operating expenses. Once we subtract interest expense, we get earnings before taxes. You can think of this as the taxable income. And then if the tax rate is given, which in this case is given as 21%, we can use that to figure out the tax liability to get net income. And then net income is further distributed into dividends and addition to retained earnings. So whatever is earned, some of it is given out in the form of dividends to the people who put in the equity, which are the shareholders, and some is retained back into the business. So the sum of dividends and addition to retained earnings has to equal net income. So this is a very basic structure of the income statement. So now it's just a matter of putting in the numbers. We are told that sales are $497,000, costs are given as $276,000, and depreciation is also given as $43,000. So all we got to do is say equal to this number minus the costs and minus the depreciation. So this will give you earnings before interest and taxes. Because the interest expense is given as well, which is $24,000, you can use that to figure out earnings before taxes. So from Ebit, you just subtract the interest expense. And there you have it, your earnings before taxes, which is your taxable income. Taxes are 21% of this. So now you can say equal to 0.21, which is 21%, times $154,000. This is your taxes. This is your tax liability. So what you are able to take home, which is net income, is just this number minus this number right here. Now we are told that the company paid out $30,000 in dividends. So let's put dividends of $30,000. And this is in blue because this is information that is given to us. If out of a net income of about $121,000, $30,000 was given in the form of dividends, then the addition to retained earnings has to be the remainder. So all we got to do is $121,660 minus $30,000. So the addition to retained earnings must have been $91,660. This is the money that was plowed back into the business, which means that equity holders are saying, hey, we're only going to take out $30,000 in dividends and put the remainder back into the business, maybe to buy more assets or fund future growth. So there you have it. A quick video on how to build a very, very basic income statement and how to use it to calculate net income and addition to retained earnings. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.